What's going on, guys, and welcome back to the channel. If you're new around here, my name is Jason, and on this channel you'll find videos on personal finance, investing, and money related topics. And in today's video, I'll be covering 3 Canadian stocks that you can hold within your portfolio for the long term. So if you're excited for today's video, hit that like button so I know to make more videos like this in the future. Also, a quick reminder, I'm not a financial advisor, so if you're ever going to invest into any type of investment or company or stock or whatever it may be, always do your own research and consult a professional. This video is strictly for entertainment purposes only. And with that being said, let's jump right into today's video and cover the 3 Canadian stocks that you can hold for the long term. The first company on the list is called Sunlife Financial, and the ticker symbol on this is SLF on the Toronto Stock Exchange. Currently, Sunlife Financial is trading a little over $61 per share, and Sunlife Financial is in the financial services sector, mainly in the insurance industry. And they are a financial services company that provides insurance, wealth, and asset management solutions to individuals and corporate clients worldwide. And they offer products such as life, health, dental, critical illness, and long-term care insurance products. And pulling up Sun Life Financial's year-to-date chart, you can see they're up almost 9% year-to-date. And if you look at Sun Life Financial over the last year, they're up only about 1%. And if you take a step back and take a look at the 5-year chart, Sun Life Financial is up over 51%. Currently, Sun Life Financial has a market cap of $35.833 billion with a beta of 1 and a PE ratio of 14.94 with an EPS of 4.10. Sun Life Financial also pays a pretty decent dividend of 3.49%. And because they pay a dividend, if we take a look at their dividend summary, Sun Life's payout ratio is a little over 36%, which to me, that shows that there's a lot of room for a growth for the dividend in the future. And their 5-year growth rate on their dividend is 7.36%, and they've been consistently growing their dividends for the last 5 years. And being one of the top companies in the insurance sector, looking at Sun Life Financial's earnings, you can see last 4 of their quarters, they beat their earnings expectations every single time. And jumping over to their quarterly financials, you can see Q3 and Q4, they did take a little bit of a dive compared to Q2 of 2020. Also, if we take a look at the analyst recommended rating for Sun Life Financial, currently it's at a 2.1, which is a buy, and an average analyst price target is currently sitting at almost $69 per share, where currently Sun Life trades at a little over $61 per share. So you can see there is some room for growth here. Looking at Sun Life's estimated revenue numbers for 2021 and 2022, the average for 2021 is almost at $41 billion, where in the year 2022, they're looking at almost $43 billion in estimated revenue. Moving over to Sun Life's growth estimates for the next year, they're looking to grow about 7.8%, and over the next 5 years, they're looking to grow about 7.70% year over year. And taking a look at Sun Life Financial's income statement on a quarterly level and breaking down the numbers, if you take a look at their total revenues, you can see they're showing pretty good numbers. And if you take a look at the net income, they're showing some really good numbers to solidify that this company is worth holding on to for the long term. And here's why I think having Sun Life Financial in your portfolio is a good thing over the long term in the next 5, 10, 15 years. Because over the last 5 years, Sun Life has increased its dividends 4 times on a year-over-year basis. And that's for an average annual increase of 7.63%. And I'm pretty confident over the next couple of years, they will continue to grow their dividend. If you take a look at Sun Life's investor presentation, you'll see that they're comparing their full year results for 2020 compared to 2019. And although their net income did drop about 8% versus 2019, to me, that's not that big of a deal because obviously last year with the pandemic, pretty much every company took a toll. Their insurance sales were down about 1%, and I'm pretty confident with all of these numbers that they didn't meet compared to 2019, they will be beating them on the next couple of years. Also, in the investor presentation, Sun Life showed that Canada is a growth market for them, where they proactively connected with clients over 15 million times in 2020 via their digital coach Ella, which resulted in additional $700 million in wealth deposits and $1 billion in insurance coverage. They also processed 94% of their group benefits, health, and dental claims digitally digitally. Sunlife also applied artificial intelligence and predictive modeling to accelerate and improve the individual insurance underwriting process. And as for Sunlife's US market, they've been deepening client relationships, and through the pandemic, Sunlife managed 100% of their clients' enrollments virtually, which ended up contributing to a 13% overall increase in employee benefit sales for the year. Sunlife is also positioned in Asia's largest and fastest growing markets, where their new TP Bank bancassurance partnership in Vietnam nearly doubled in sales. And they also entered their second bancassurance partnership with Asia Commercial Joint Stock Bank, with the sales starting in 2021. And within their presentation, you can see the words virtual and digital come up quite often. And this is because everything is moving digitally and everything's going to be done even more quicker. Sunlife is also capturing growth opportunities in Asia, in local markets such as Philippines, China, Indonesia, India, Vietnam, Malaysia. So they've got a huge footprint outside of North America. Company number 2 on the list is Algonquin Power and Utilities Corp. The ticker symbol on this company is AQN on the Toronto Stock Exchange, and currently Algonquin Power is trading a little over $19 per share. And this company is situated in the utilities sector, and through its subsidiaries, they own and operate a portfolio of regulated and non-regulated generation, distribution, and transmission utility assets in Canada and the United States. They don't only generate, but they also sell electrical energy through non-regulated renewable and clean energy power generation facilities. And Algonquin also owns and operates hydroelectric, wind, solar, and thermal facilities. And pulling up Algonquin's year-to-date chart, you can see they're down a little over 5% year-to-date. And if you pull back and take a look at the 1-year chart, they are down about 6%. If that was scaring you, don't worry. If you take a look at the 5-year chart, they are up almost over 83%, with a market cap sitting at almost $11.8 billion and a beta of 0.27 and a PE ratio of 24.33, along with the EPS of 0.81. Algonquin Power will pay you a dividend as well of about 3.91%. And because they pay out a dividend, let's take a look at their dividend summary. Looking at the payout ratio, it's at 95.20%, and that's considered pretty high. They have a 5-year growth rate of about 10%, and they've been growing their dividends for the last 11 years. You can see that the last 2 of the 4 quarters, they have missed their earnings, and they will be announcing their 2020 Q4 results on March 4th. But if you pull up the quarterly financials, you can see their Q2 and Q3 numbers have relatively stayed pretty much the same, other than their earnings have dropped a little bit compared to Q2 of 2020. Taking a look at the analyst recommended rating for Algonquin Power, currently it's sitting at 2.6, which is close to a buy and a hold, but it's showing a buy as of right now. And the average analyst price target is about $18 per share, and currently this is almost up close to $20 per share. Looking at the average estimated revenues for 2021, they're looking to have revenues of almost $2.10 billion. And pulling up their growth estimates for next year, they're looking to grow about 12.30%, and over the next 5 years, they're looking to grow 8.10% per year. And here's why I believe having Algonquin Power within your portfolio over the next couple of years is actually beneficial, because their utilities operations, which makes up about 65% of their business, it offers investors incredible reliability and stability, while the other 35% of the business is in their renewable energy generation segment. And of course, renewable energy is where everything is headed and is considered one of the best long-term growth industries. So with being invested into Algonquin, this gives you the best of both worlds. Not only are you exposed to some superior long-term growth potential, the majority of your investment is protected by highly resilient operations. And putting these two together, this is why it makes Algonquin one of the most attractive stocks to have within your portfolio over the long term. And Algonquin Power classifies its business into 2 segments, the first being Liberty Utilities and the second one is Liberty Power. Now, Liberty Utilities composes 70% of the company's businesses, where they provide water, electricity, and gas to around 1 million customers across the US, Canada, Chile, and Bermuda, while the remaining 30% of the company's business involves developing and operating renewable power generating facilities under their Liberty Power. Also, Algonquin Power has $3.1 billion in renewable assets and $6.3 billion in regulated utility assets over the next 5 years. And this is pretty impressive because these pipeline of projects could increase its power generating capacity by 3.4 gigawatts. And last but not least, company number 3 on the list is Canadian Pacific Railway, and the ticker symbol on this is CP on the Toronto Stock Exchange. Currently, Canadian Pacific Railway is trading at a little over $453 per share, with a market cap sitting at $60.453 billion, a beta of 0.71, and a PE ratio of 25.24, with an EPS of 17.97. Canadian Pacific Railway also pays a dividend. It's kind of a small one, but they pay out 0.83%. And looking at their dividend summary, their payout ratio is at 16.38%, which is extremely low, so that means they have a ton of room if they needed to grow their dividends over the long term. They've got a 5-year growth rate of 19.74% and consistently growing their dividend for the last 5 years. Canadian Pacific Railway is in the industrial sector, primarily in the railroads industry. And with their subsidiaries, they own and operate a transcontinental freight railway in Canada and the US. And they transport bulk commodities such as grain, coal, potash, fertilizers, and sulfur. They merchandise freight such as energy, chemicals and plastics, minerals and consumer, automotive, and forest products. And they also do transporting overseas in containers, and they have a network of approximately 13,000 miles that serves business centers in Quebec and British Columbia, Canada, and the United States Northeast and Midwest regions. Pulling up Canadian Pacific Railway's year-to-date chart, they are up about 3%, and pulling up their 1-year chart, they are up almost 34%. And looking at the 5-year chart, they are up almost 172%. Also, looking at their quarterly financials, it stayed pretty much even out. The only time it kind of took a dip was in Q2 and Q3 of 2020, but since then they have relatively come back pretty well. Now, taking a look at the average analyst price target, it's sitting at almost $313 per share, where currently the stock trades at a little over $453 per share. Also, taking a look at their next 5-year growth estimates, they're looking to grow about 16% year over year. And if you take a look at the quarterly income statement, just by looking at the revenues, you can see the strong numbers that this company produces. Even looking at the net income and how much it's growing and has grown. And if you pull up Canadian Pacific Railway's highlights, they've done a really good job in their highlights showing Q4 and 2020 overall. And you can see clearly they have strong earnings growth and margin improvement despite the year that we had with the pandemic. And they also reported a record full year operating performance. And they also have a ton of momentum going into 2021 with strong pipeline opportunities, which will help further grow this company. And here's why I think having Canadian Pacific Railway in your portfolio would actually be a good thing in the long term. Again, I keep saying long term because to me personally, I'm thinking long term of any company that I'm holding within my portfolio, whether it be 5 years, 10 years, 15 years, 20 years, etc. But here's why having Canadian Pacific Railway in your portfolio makes sense. Given that this company has a very strong competitive moat, it's nearly impossible for other people to come into the industry or other companies to access and build large-scale transportation infrastructure such as railroads. Despite the pandemic, the company has actually performed very, very well because even during the pandemic, products, goods, and commodities needed to be transported. Now, of the two companies that I spoke about in this video earlier on, yes, this company does pay a much lower dividend, but you have to take a look at the bigger picture and see that they're just reinvesting into new opportunities that will further make this company grow. And they've been really prioritizing the shift towards renewable energies as they recently started construction on a large solar energy project. And this just shows the mentality of their management that they love to think in the future and long term. And that's the end of today's video. I hope you enjoyed it. And if you did, make sure to hit the subscribe button down below if you made it this far. And with that being said, I will see you guys on the next video.